Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, here with you again on PVN Network. Today we're going to focus on two aspects that are moving the market today, specifically oil and refined products. Now, the first one is the EIA report that came out today, which comes out every Wednesday looking at last week's information. And we're going to try to take that, pick it apart, and figure out, what is going to happen on the next, let's call it rolling 4 weeks. And then we're going to look at the huge data dump that we've had in both the US and international markets to figure out, okay, well, is there going to be a longer term recovery in some of this oil and refined product demand? So now let's turn to the US and focus on what happened in the EIA. Now, the EIA is broken out into PADs. Now, the PADs are defined as Petroleum Administration for Defense Districts. And now we have 5 PADs, PAD 1, East Coast, PAD 2, Mid-Continent, PAD 3, the Gulf of Mexico, PAD 4, the Rockies, and PAD 5, the West Coast. So it's just important to know how is that broken up when we start talking about, where are these refined products going, where are they moving, and where are the imports happening for oil. So now let's turn to PAD 3, which has been a focus for us. So PAD 3 had a build of about 7 million barrels, and the overall US had a build, once you factor in the SPR, which is the Strategic Petroleum Reserve, of 10.14 million barrels. So now PAD 3 already has storage that's allocated to the Saudi crude that is starting to arrive this week and will accelerate into the end of May. So we had imports into PAD 3 increase by 756,000 barrels a day. Now, they've already allocated some of this storage to the oil that they know is coming. So this is only going to increase over the next few weeks, which is going to make some of these builds bigger. We had some declines in PAD 1, which is the East Coast, and PAD 5, which is the West Coast, but that's because we've seen the biggest slowdown in refinery capacity in these regions. And the answer is why. Well, the question is really why. And the answer is because we've seen a big drop in total demand for refined products, both gasoline and diesel. So when we look at gasoline, because the gasoline number, as we said last week, we were going to see it bottom and start to recover a little bit. That's just showing consumers. Consumers are starting to drive a little bit more. Things are starting to get a little bit better, but it doesn't mean they're going anywhere to buy something just to get out of the house. Diesel is going to be the indicator as to supply chain, industrial, how are things really starting to look on an economic basis. So the PAD 3 builds will continue. Gasoline started to backfill the system a little bit. We had gasoline demand is projected to be up by about 549,000 barrels a day, which is about 5.9 million barrels a day of demand, which is good. It's good to see, things flowing through. But in terms of long-term recovery, we're still at all-time lows. We're just a little bit better than the all-time lows that we hit a couple weeks ago. We're still well off where we should be at this time of the year. And so seasonally adjusted is how we always want to look at this. So seasonally adjusted, it's still a terrible situation. And storage is still in a massive glut, specifically on gasoline. And how do we know that? PAD 1, we've seen a huge drop, where right now the drop from Europe has increased in terms of the amount of gasoline coming over from Europe into the East Coast. And this is due to the fact that we have, weak demand, but also maxed out storage. So even as driving starts to increase, we still have a significant amount of storage to work through. So distillate is the bigger component. Distillate is going to be a huge component as to how bad is the economy going to get. And we've already seen a huge drop, specifically in Q1 of 2020. Now, you may say, okay, Q1 2020 has already happened. We already know it's at it was down 4.8%. But we expected it to be only down about 3.9%. So now let's project that forward. Let's look at the international market. Let's try to tie this EIA into the global economy. So now we start to look at, okay, well, the exports are going to slow coming from Europe, and it's going to remain slow through May and into June. We've had Nigeria essentially cut and defer shipments out of May into June, some shipments from June into, most likely July, or they'll keep kicking it down the curve. We've had Japan that's increased their lockdown by a month. And we've had this continued slowdown on the distillate side, diesel side, shipping side. So when I say, we've seen this slowdown, we really have to look at some key aspects to the global economy. And the global economy is really driven by that import-export data. And some of the biggest export countries are both Germany, South Korea, and China. So here, in terms of Germany, we've had a big step down in GDP. They printed something below 6%. We've had a huge drop in PMIs across the board, and all of the early Fed data coming out within the US is reaching all-time lows, which again isn't surprising given the fact that we're in the middle of a pandemic. But we want to kind of project forward. What is happening going forward? And the demand isn't there from the diesel perspective. And that's why we've seen distillate storage increase in Fallujah. We've seen it increase in Japan, and we continue to see it increase in Singapore because there's just nowhere for the product to go. Russia and Saudi continue to be in a knife fight in terms of prices, specifically in Belarus. So Belarus is a Russian ally, but yet they just purchased oil from Saudi because they were annoyed at the price Russia wanted to charge them. So we can see the market share continues to battle. Angola cut some of their flow, but again, Russia has seen their gasoline demand fall by 50%. This is going to be something that's going to be sticky. 50%. I don't think it'll go to 60 or 70. I think 50% is that number as people kind of settle in for the long haul. But then the problem is, how do they cut their oil production? These are Soviet era assets that run through a permafrost. You can't just turn off some of these pipes because if they don't have oil, they can literally explode or implode, or however you want to think of, the way the cold would interact with the overall pipeline. So there's going to be an issue in terms of how do they actually ramp down, which is why we have to focus on the export market, not just what they're saying on the production side. Production's nice, but how is it impacting the global oversupply we have? And the reason why we focus so much on that export level is also on the import level. And that's why if you look at South Korea, you look at Germany, you look at Japan, Japan is the third largest economy, fourth largest importer of oil. So if you have a slowdown on this level, you're going to see that distillate continue to build. And where is it going to go? Now, China has increased their allotment of exports of distillate. So what does this mean exactly? Where is the distillate going? Why are they doing this? It's because they don't have domestic demand and storage is full. So we've already seen refiners start to slow down a little bit, and we've seen distillate exports start to increase, specifically into Singapore for storage, but it's also starting to show up in both Africa as well as Europe. And Africa is an interesting area because we have a significant amount of Nigerian crude sitting there, and now gasoline and distillate is showing up. We have a lot of Nigerian crude sitting in Gibraltar and some other regions, which is why to see Nigeria kick this can down the road makes a lot of sense. Now, what are they going to do? It's an emerging market. So they just got another loan of $3.4 million from the IMF, which should be able to bridge some gap, but not really, how long can they really last? Saudi Arabia is showing you what pain looks like this is the largest, or in terms of pace, it's the largest pace that they've had in a decrease in foreign reserves. And this is why we always focus on the foreign reserves, because as countries can't export, they can't take in those dollars, which means that they're going to have to liquidate their foreign reserves in order to finance some of this. Now, Saudi is a strong country. They can hit the debt market. So the fact that they have to issue these foreign reserves is a huge problem. So let's just wrap up what we've talked about, because we've hit a lot of different topics. So now the EIA data, came in better than estimates. But remember, some of this storage has already been spoken for. Distillate builds continue to outpace estimates, even as gasoline did have some glimmer of hope. But again, this is something that is not really back to normal. It's just we're off the lows. This is something where the gasoline numbers will continue to beat estimates, or unless estimates adjust. But the benefit of our gasoline situation is we're going to take in less imports of clean products, specifically from Europe, which will help some of this clearing of our deck, if you will. Disti is going to continue to be a problem, specifically with diesel. And you're seeing that, reverberate through the system, specifically in some of these key areas with China pushing more and more product into the market. So, we're going to continue to focus on this. And when we talk on Friday, we're going to touch on some key components in terms of, well, what does this look like going forward now that, Iran is starting to lose some political clout in both Iraq and now Lebanon? What does this look like going forward? Is this a short-term bullish scenario with, potential conflict and long-term bearish, or what does this mean for regime change if possible? So these are some fun things that we're going to try to talk about and make sense of as we go forward to figure out, are oil prices right to see this kind of rise, or should we start to fade this? And I would say, short term, you'd want to fade some of this move because a lot of it has been priced in. We've had some bad news get washed away with the idea that the Gilead drug, which we're all hopeful is a success, starts to overshadow some of the weak economic data that we've seen in Q1, and so far some of the really bad leading indicators that we have for Q2. So thanks again for joining us. Please remember to subscribe and ask any questions that you have in the comments section. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you with Primary Vision Network. I look forward to talking to you again. Thanks. Bye.